The year 2000, everyone believes the internet will revolutionize everything. Pets, com goes public. Investors throw billions at companies with no revenue, no profits, just a com at the end of their name. The anatomy of a bubble. The 4 stages. Every bubble in history follows the same 4-stage pattern. Understanding these stages reveals exactly where we are in the AI bubble cycle. Stage 1. The stealth phase. The technology emerges. Early adopters recognize its potential. A handful of visionary companies start building. Investment is modest. Skeptics outnumber believers. The public barely notices. For AI, this phase ran from roughly 2012 to 2019. DeepMind beats humans at Go. Google develops transformer architecture. OpenAI is founded as a research lab. Smart people recognize something important is happening, but valuations remain reasonable. Nobody is mortgaging their house to buy Nvidia stock. Stage 2, the awareness phase. The technology proves itself with undeniable demonstrations. Media coverage increases. Early investors make spectacular returns. More money flows in. Valuations start climbing above historical norms, but bulls argue the technology justifies higher multiples. Skepticism begins giving way to belief for AI. This phase began in late 2022 when ChatGPT launched and reached 100 million users faster than any application in history. Suddenly, everyone could see that AI wasn't theoretical. It was here, it was accessible, and it was impressive. Nvidia stock started its meteoric rise. Tech companies scrambled to announce AI initiatives. Stage 3, the mania phase. This is where we are now with AI in 2025. The technology dominates media coverage. Everyone has an opinion. Companies with any AI connection see their valuations soar. Investors abandon traditional valuation metrics, arguing that old measures can't capture the revolutionary nature of the technology. Anyone questioning the valuations gets dismissed as not understanding the paradigm shift. The fear of missing out becomes overwhelming. Rational investors who recognize the bubble feel compelled to participate anyway, because sitting out means watching everyone else get rich. The bubble becomes self-reinforcing as rising prices validate the mania and attract more buyers. Specific characteristics of the mania phase that we're seeing now. Nvidia's market cap exceeds $3 trillion, more than the entire German stock market. The company trades at over 65 times earnings. Microsoft's valuation reflects expectations that AI will add hundreds of billions to their revenue. Every tech company claims AI will transform their business, even when the connection is tenuous at best. Startups with minimal revenue raise billions in funding by adding AI-powered to their pitch decks. The 7 largest tech companies, Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla, now represent 30% of the entire S&P 500's market value. This concentration hasn't existed since 1929. The entire market's performance depends on investors continuing to believe the AI story. October 29, 2025, a Wednesday morning that will echo through financial history. At 9:30 a.m. Eastern Time, trading begins on Wall Street. Within minutes, something extraordinary happens, something that has never occurred in the entire history of capitalism. Nvidia, a company that started making graphics cards for video games, crosses $5 trillion in market value. Not 5 billion, not 500 billion, $5 trillion. To put that in perspective, Nvidia, a single company, is now worth more than the entire economy of Japan, more than the GDP of Germany, more than every country on Earth except the United States and China. One company, $5 trillion. But here's what should make your blood run cold. Nvidia isn't alone in this stratosphere. Apple and Microsoft have both crossed $4 trillion. Together, just 7 companies, the so-called Magnificent Seven, command a combined market value of $21.5 trillion. That's roughly 16% of all stocks on the entire planet. 7 companies. 16% of global equity value. And they're all betting everything on the same technology, artificial intelligence. Now, I need you to understand something. This isn't a story about technology. This is a story about the greatest transfer of wealth and the greatest destruction of wealth you will witness in your lifetime. Because while these companies are worth trillions on paper, they're spending money they don't have on infrastructure that may never pay for itself in a circular financing scheme that would make Bernie Madoff blush. The numbers are so absurd, so disconnected from reality, that even the people creating this bubble are openly admitting it exists. Sam Altman, the CEO of OpenAI, the poster child of the AI revolution, said it himself. I do think some investors are likely to lose a lot of money. Mark Zuckerberg, when asked if we're in an AI bubble, replied, quite possible. Jeff Bezos said, we probably are in one. These aren't skeptics or critics. These are the people building the AI empire. And they're telling you right to your face that it's a bubble. But here's what they're not telling you. The math doesn't work. It can't work. It's mathematically impossible. Tech companies will spend over $1.6 trillion on AI infrastructure by 2030. But to justify that spending, they would need to generate revenue that simply doesn't exist. According to Bain and Company, AI companies will need $2 trillion in annual revenue by 2030 just to pay for the computing power. But they're likely to fall $800 billion short. That's not a rounding error. That's an existential gap. That's the difference between a technology revolution and the largest wealth destruction event since the Great Depression. $10 trillion. That's how much could vanish almost overnight when this bubble bursts. Not gradually, not over years, overnight, because that's how bubbles work. They don't deflate slowly like a leaking tire. They explode like a balloon hitting a needle. And right now, we're watching that needle get closer and closer to the surface. The only question is, will you be holding the balloon when it pops? September 2025. Two press releases go out within days of each other. Separately, they seem like normal business deals. Together, they reveal something deeply disturbing about how the AI industry actually works. First, NVIDIA announces it will invest up to $100 billion in OpenAI to fund new data centers. Second, OpenAI announces it will purchase millions of NVIDIA chips for those same facilities. Let me say that again, slower this time. NVIDIA gives money to OpenAI. Then OpenAI uses that money to buy from NVIDIA. This isn't just circular. It's a perfect circle. Money goes from company A to company B, then immediately returns to company A. It's like me lending you $50, then you using that $50 to buy something from me for $50. No actual value has been created. Money has simply completed a loop. But here's where it gets truly bizarre. When these deals were announced, both companies' stock prices surged. NVIDIA's market cap jumped to billions. OpenAI's valuation already at $500 billion for a company that's never made a profit solidified. Investors looked at this circular transaction and thought, this is great news. This is the smoking gun. This is the moment when the AI bubble stopped being a theory and became an observable fact. Bloomberg called it an increasingly complex and interconnected web of business transactions. That's corporate speak for a house of cards, but it gets stranger, much stranger. Microsoft, one of OpenAI's largest shareholders, is also a major customer of CoreWeave, a cloud computing company. And NVIDIA holds a significant equity stake in CoreWeave. Meanwhile, OpenAI just took a 10% stake in AMD, which is NVIDIA's main competitor while still being NVIDIA's biggest customer. Are you following this? Because even the people making these deals probably cut and map out who owns whom and who is paying whom anymore. It's a financial. Ouroboros, a snake eating its own tail, except the snake is made of trillion-dollar companies and the tail is made of money that doesn't technically exist yet. Here's what's really happening, and why you should care. These companies are using each other's equity as collateral to fund spending on infrastructure, whose returns are purely theoretical. They're booking each other's purchases as revenue, which inflates their earnings, which raises their stock prices, which increases their market capitalization, which makes it easier to borrow more money or issue more stock, which funds more circular deals. It's a financial perpetual motion machine. And like all perpetual motion machines, it violates the fundamental laws of economics. You cannot create value out of thin air indefinitely. But here's the curiosity gap, the thing that should be keeping you awake at night. Why are the smartest people in finance falling for this? These aren't idiots. The people running Vanguard, BlackRock, State Street, the three largest asset management firms in the world, collectively hold 5.12 billion shares of NVIDIA. These firms manage trillions of dollars for millions of investors. Goldman Sachs, Morgan Stanley, JP Morgan, they all see the same numbers you're hearing right now. They all understand circular financing. They all remember the dot-com bubble, so why are they still buying? Because they're betting they can get out before the music stops. They're playing a game of financial musical chairs with your retirement savings, and they believe they'll find a seat before the crash. That's the gap between what they know and what they're doing. That's the curiosity that should terrify you. They know it's a bubble, they're buying anyway. Because in the short term, bubbles make people rich. It's the long term, when reality reasserts itself, that destroys fortunes. The question isn't whether the smart money knows it's a bubble. The question is, do you know when they plan to get out? Let's talk about math. Cold, hard, unforgiving math. OpenAI, the company at the center of this entire AI boom, has committed to spending $1.4 trillion to develop its product. That's trillion, with a T, their projected revenue for 2025. $13 billion. A pause for emphasis. Do you understand what that ratio means? They're spending 100 times more than they're earning. Sam Altman claims revenues might hit $100 billion by 2027. Let us be wildly optimistic and assume that happens. They would still be spending 14 times more than they earn. And here's the kicker. According to a disclosure by Microsoft, OpenAI may have lost $12 billion in the third quarter of 2025 alone. One quarter. $12 billion. Gone. And yet, venture capitalists have valued this company at $500 billion. That makes OpenAI the world's most valuable company that has never turned a profit. Not the most valuable startup. The most valuable company in human history to have never made a single dollar of profit. But OpenAI isn't unique. The entire AI industry is operating on mathematics that would make Enron accountants blush. Michael Burry, the man who predicted the 2008 housing crash, the man whose story was told in The Big Short, recently broke a 2-year silence to warn about what he calls one of the most common frauds in the modern era. What fraud? Depreciation accounting. Here's how this works and why it matters when companies like Microsoft, Meta, and Oracle build AI data centers. They buy tens of billions of dollars in GPUs, servers, cooling systems hardware that historically loses value fast. Normally you depreciate these assets over 3 to 4 years, which means you account for that loss of value in your financial statements. But recently, these companies quietly changed their depreciation schedules. Instead of 3 years, they're now depreciating over 6 years. Some are stretching it even longer. Why does this matter? Because depreciation is an expense. When you reduce your expenses on paper, your reported profits go up. And when your profits go up, your stock price rises. Burry estimates that big tech will understate depreciation by $176 billion between 2026 and 2028. That would inflate reported profits by almost 27% at Oracle and over 20% at Meta. This is the conflict at the heart of the AI bubble, the battle between reported earnings and actual economics. On paper, these companies look phenomenally profitable. In reality, they're burning through cash at a rate that would bankrupt entire countries. J.P. Morgan S. Michael Sembles notes something chilling. AI-related stocks have accounted for 75% of S&P 500 returns, 80% of earnings growth, and 90% of capital spending growth since ChatGPT launched in November 2022. Read that again. 90% of capital spending growth. The entire market is being held up by AI spending, but that spending isn't generating proportional returns. It's generating hope. Here is the conflict in its starkest terms. Tech companies listed in the S&P 500 are spending $400 billion per year on AI. That number is projected to hit $1.5 trillion by 2030. McKinsey predicts total AI infrastructure costs could reach $5.2 trillion by the end of the decade, but revenue? OpenAI, the biggest AI company, is generating only $13 billion in 2025. The entire industry revenue is nowhere close to justifying the spending. It's like building 100 luxury hotels in the desert and hoping customers will eventually show up. Except in this case, you're not just building hotels, you're borrowing trillions of dollars to build hotels, using the hotels themselves as collateral, while selling pieces of the hotels to each other and calling it revenue. David Einhorn, founder of Greenlight Capital, put it bluntly. The numbers that are being thrown around are so extreme that it's really hard to understand them. I'm sure it's not zero, but there's a reasonable chance that a tremendous amount of capital destruction is going to come through this cycle. A tremendous amount of capital destruction. That's not hyperbole. That's a hedge fund manager who's seen multiple bubbles warning that this one could be worse than anything we've experienced before. Because the conflict isn't just financial, it's existential. These companies have bet everything on AI generating returns that justify trillion-dollar investments. If that doesn't happen, if AI plateaus, if adoption slows, if the technology hits a ceiling, the entire structure collapses. And unlike previous bubbles, this one is holding up the entire market. When the Magnificent Seven fall, they won't fall alone. They'll take your index funds, your retirement accounts, your pension, everything down with them. That's not a conflict. That's a war between fantasy and reality. And reality always wins. I want you to imagine something with me. Close your eyes if you're not driving. It's a Tuesday evening. You're making dinner. Your phone buzzes. It's a notification from your investment app. You glance at it casually, expecting the usual small fluctuations. Your portfolio is down 40%, not 4%. 40%. You check again. You refresh the app. The number doesn't change. You turn on the news. CNBC is showing a bloodbath. The S&P 500 is down 35%. The Nasdaq has fallen 50%. Nvidia, which was worth $5 trillion this morning, has lost $2 trillion in a single trading session. OpenAI's latest quarterly report revealed what everyone suspected but nobody wanted to admit. The revenue is oncoming. The AI models have hit a performance wall. The promised revolution is delayed, maybe indefinitely. And within hours, the circular financing system collapsed. Microsoft couldn't justify its AI spending. That caused CoreWeave's revenue to crater. That meant Nvidia's biggest customer couldn't pay for orders. That caused Nvidia's stock to plummet. That triggered margin calls on investors who'd borrowed to buy tech stocks. That forced more selling. That created more margin calls. It's a cascade, a domino effect. A chain reaction that feeds on itself, getting worse with every passing hour. By the time you go to bed that night, everything you've saved for 30 years has been cut in half. Your 401k gone, your IA decimated. Your kid's college fund insufficient, and the worst part? You didn't even know you were exposed. You thought you were being smart, investing in index funds? But you didn't realize that Nvidia alone makes up 8% of the S&P 500, nearly 12% of the Nasdaq. You thought you were diversified. You weren't. You were concentrated in the biggest bubble in human history, and you didn't even know it. This isn't meant to scare you. Well, actually, it is. Because fear is appropriate when you're standing on the edge of a cliff. Right now, if you own any broad market index fund, you're massively exposed to the AI bubble whether you realize it or not. The S&P 500 is trading at 23 times forward earnings levels not seen since the dot-com crash. But that's a lie. This is foreseeable. People are predicting it right now. Michael Burry predicted it. David Einhorn predicted it. Ray Dalio said it's very similar to the dot-com bubble. The Bank of England issued warnings. The IMF issued warnings. Even Sam Altman, The guy who has the most to gain from the AI bubble continuing admitted people will lose a lot of money. The signs are there. They've always been there. The question is, will you pay attention this time? Or will you be one of the people who, 5 years from now, asks, how did nobody see this coming? Because the truth is, people saw it. You just didn't want to believe them. Let's talk about what you actually need to know, what you can actually do. Because here's the thing, you can't stop the bubble from popping. That's out of your control, but you can control your exposure. You can control what happens to your wealth when the bubble bursts. So let me give you the lessons, the real, actionable lessons drawn from 425 years of financial bubbles, applied specifically to the AI bubble we're living through right now. Lesson 1. Every bubble has predictable stages, and we're in stage 4. There are 5 stages to every bubble. Stage 1. The innovation. AI is real. Large language models are genuinely impressive. This isn't tulip mania where the product was worthless. AI has legitimate use cases. Stage 2. Early success. Some companies made real money from AI. OpenAI's revenue genuinely grew from 0 to 13 billion. That's real. Stage 3. Financialization. This is where we enter dangerous territory. When companies started borrowing trillions to build infrastructure, when circular financing deals became normal, when valuations disconnected from earnings, that's when the bubble truly formed. Stage 4. Euphoria. We're here right now. This is when everyone knows about AI, when your Uber driver asks if you've tried ChatGPT, when companies add AI powered to their product descriptions to boost stock prices, when investors don't care about profits because they believe in the vision. Stage 5. The catalyst. This is what we're waiting for. It's never what you expect. In 2000, it was rising interest rates and a handful of dot-coms admitting they'd never be profitable. In 2008, it was subprime mortgages defaulting. For AI, it could be anything. A major company admitting AI isn't generating expected returns. A fraud revelation at a key player. China releasing a model that makes Western AI investments obsolete. A technical limitation that becomes impossible to overcome. The catalyst is unknowable, but it's coming. Because it always comes. Lesson 2. The math never lies. Listen carefully. Companies cannot spend $400 billion per year and generate only $13 billion in revenue indefinitely. The math has to work eventually. Investors will demand returns. Debt will come due. Expenses will need to match income. Right now, the AI industry is operating on faith that future revenue will justify current spending. But faith isn't a business model. Bain predicts an $800 billion shortfall between needed revenue and actual revenue by 2030. That's not a small gap. That's a chasm. And when reality meets expectations, the correction will be brutal. Lesson 3. Circular financing always ends badly. History is littered with circular financing schemes. The South Sea Company in 1720, using its own stock to buy government debt, then using that debt as collateral to issue more stock. The 1990s dot-com bubble. Companies buying ads from each other and booking it as revenue. The 2008 housing crisis. Banks selling mortgage to each other, repackaging them, and selling them again every single time. It ends the same way. The music stops. The circle breaks. And everyone realizes they've been passing the same money around in increasingly complex ways while pretending wealth was being created. The OpenAI, NVIDIA, Microsoft CoreWeave deals are textbook circular financing. And they will end the same way every circular financing scheme in history has ended. Catastrophically, the predictions. 3 scenarios for the AI bubble. Voice becomes measured and analytical. Scenario 1, the slow deflation, 20% probability. In this best-case scenario, AI revenue gradually catches up with spending. Maybe it takes 10 years instead of 5. Maybe companies write off hundreds of billions in losses but survive. Stock prices decline 30 to 40% but don't crash entirely. This requires near-perfect execution, continued exponential improvements in AI capabilities, and patience from investors who are currently demanding returns. Historically, this almost never happens. Bubbles don't deflate slowly. But there's a small chance, especially if governments step in with bailouts or regulatory changes that paper over the losses. Scenario 2. The standard crash, 50% probability. This is the most likely outcome, based on historical patterns. Something triggers a revaluation, perhaps disappointing earnings from a major player, perhaps a scandal, perhaps a technical breakthrough that renders current AI infrastructure obsolete. Stock prices for AI companies decline 50 to 70%. The Magnificent Seven lose 10 to 15 trillion in combined market value. The broader market drops 35 to 45%. It's bad. Really bad. But it's survivable if you're prepared. Recovery takes 5 to 7 years. The AI industry continues to exist but at more reasonable valuations. Some companies go bankrupt. Others are acquired at fire sale prices. This is your 2000.com scenario. Painful, wealth destroying but not civilization ending. Scenario 3. The systemic collapse, 30% probability. This is the nightmare scenario. And it's more likely than most people realize. In this case, the AI bubble doesn't pop in isolation. Because the Magnificent Seven now represent such a large percentage of global equity value, and because so much debt is collateralized against these stocks, a crash in AI triggers a broader financial crisis. Pension funds holding index funds get decimated. Banks that loan money against tech stocks face defaults, the credit markets freeze. We see a cascade of margin calls, forced liquidations, and bankruptcies similar to 2008, but potentially worse because the amounts involved are larger and the interconnections are tighter. Stock markets globally decline 50 to 60%. The AI sector loses 90% of its value. We enter a recession or possibly a depression. Recovery takes a decade or more. This is the scenario that keeps central bankers awake at night. Because unlike 2008, which was concentrated in housing and financial services, this bubble is concentrated in the companies that power the entire digital economy. The collateral damage would be unprecedented. What you can do right now, concrete actions. Action 1. Understand your actual AI exposure. Go look at your investment accounts right now. If you own an S&P 500 index fund, you have 8% of your money in Nvidia alone. Nearly 30% of your money is in the Magnificent Seven. That's not diversification. That's concentration risk masquerading as diversification. Action 2. Rebalance immediately. This doesn't mean sell everything and hide cash under your mattress. It means getting your AI exposure down to reasonable levels. Consider reducing equity positions from 80 to 90% to 50 to 60%. Move the difference to treasury bonds, boring, safe, liquid, gold or precious metals, 10 to 15% of portfolio, international stocks and markets less exposed to the AI bubble. Cash, yes, boring. But boring keeps you alive when everyone else is drowning. Action 3. If you're overweight tech, you're overweight the bubble. If you're 401k is automatically investing in an S&P 500 fund every paycheck. Your dollar cost averaging into a bubble. Consider redirecting new contributions to less risky assets until this resolves. Action 5. Build real resilience. These will tell you when we're approaching the cliff. Major companies admitting AI ROI is negative. When someone like Microsoft or Meta publicly acknowledges AI spending is ungenerating returns, insider selling accelerating. When executives start dumping their own stock, credit spreads widening. When the cost to insure against corporate defaults rises sharply, margin debt declining rapidly. When investors start paying back borrowed money, a notable company bankruptcy or near bankruptcy in the AI space. This will be the canary in the coal mine. When you see 3 or more of these simultaneously, the crash is imminent. The bottom line, the bubble is real, the crash is coming. Let me be absolutely clear about what I'm saying and what I'm not saying. I'm not saying AI isn't real or useful. It clearly is. Large language models are genuinely impressive technology. I'm not saying every tech company will go bankrupt. Many will survive, adapt, and eventually thrive. I'm saying that current valuations are insane. I'm saying the spending is unsustainable. I'm saying the circular financing is a massive red flag. And I am saying that when this bubble pops, the wealth destruction will be measured in trillions. The AI bubble isn't a theory. It's not speculation. It's math. It's history. It's the same pattern that has repeated for 4 centuries, now playing out at a scale that dwarfs anything we've seen before. Sam Altman admitted it's a bubble. Mark Zuckerberg admitted it's a bubble. Michael Burry is betting billions that it's a bubble. The Bank of England warned about it. The IMF warned about it. The signs are everywhere. The only question is whether you're paying attention. $10 trillion. That's what's at stake. That's how much wealth exists only on paper. Only as long as everyone believes the AI revolution will generate returns that justify current spending. When that belief breaks, and it will break, because it always does, the adjustment will be swift and merciless. The people who survive bubbles aren't the ones who see them coming. Lots of people see them coming. The survivors are the ones who act on what they see. The ones who reduce exposure, take profits, build resilience, and refuse to believe that this time is different because it's never different. The technology changes, the actors change, the timeline changes. But the pattern? The pattern never changes. And right now, that pattern is screaming that we're in the final act. The audience is cheering, the actors are taking their bows, and nobody's noticed that the theater is on fire. The AI bubble will burst. Not might, will. The only variables are when and how bad. Your job isn't to predict the timing. Your job is to make sure that when it happens, you're not holding the bag. Because $10 trillion is going to vanish. The only question is, will it be your $10 or someone else's? Choose wisely. History is watching. And history always repeats.